Hi, today I'm going to take you through the process of analyzing a portfolio, how to hedge against market risks, and how to identify potential market risks. And I think this is a very important topic because this is what portfolio management is all about. Selecting the right instruments to have a robust portfolio, hedging against unnecessary risks, and being able to identify risks in time so you can mitigate them in whatever ways necessary for you. And I've made a simple example of a portfolio we can analyze, and this is what a portfolio could look like. In this case, it's 60% equities, which is a mix between what I would call US tech and more European industrial stock. 30% is in bonds, which is a mix between corporate bonds and government bonds. And then 10% of the portfolio are commodities, which is a mix between precious metals and oil. And when you analyze a portfolio, you can literally look at 1,000 different things, but I would suggest that you start with the following: expected return, volatility, asset allocation, asset correlation to get to the concentration risk. And you can calculate the expected return of a portfolio by taking the expected return of one particular asset or asset class and then multiplying it by the percentage of the portfolio that it represents. So in this case, if you expect equities to return 10%, bonds to return 4%, and the commodities to return 5%, the expected return would be 7.7%. And volatility is usually measured with beta. And if beta is 1.5, it means that this asset is 50% more volatile than the market, which means higher returns, but also higher risk. And by dividing the expected return of the portfolio by the beta, you can normalize the portfolio's return by the level of risk, and therefore you're able to compare different portfolios with different risk levels to each other. It's quite similar to the Sharpe ratio, but that's a bit too complicated to get into today. And with asset allocation, you look at how heavy all the assets weigh, and if the portfolio might be overexposed to one particular asset class, or sector. And in this portfolio, you could really see that a fifth of the portfolio consists of Nvidia stock, and 55% of the portfolio is tech. So this is a very tech-heavy portfolio. And asset correlation is directly related to this because it measures to what extent assets move together. Tech, as I already said, is heavily correlated to each other, but so are gold, silver, and oil. They also tend to move together, especially when the political environment is a lot more grim, like it has been for the past months. So this, in combination with the asset allocation, gives you concentration risk. And with this portfolio, we can really say that there are too many of the same eggs in one basket. And more advanced things you can look at are, for example, value at risk and duration for bonds, but those are way too complex for just a 7-minute video. So as you can see, a portfolio comes with a risk, and most investors want to do something about that risk. And this is where hedging comes in. It's more a bit of next week's topic, but it's still important to explain how to hedge your positions. And what hedging essentially means is it means protecting your positions against inverse market movements, so movements that go against what you anticipated. And there are several instruments that you can hedge your positions with. Options, futures, and swaps are the most common derivatives that are used in hedging, and they're called derivatives because they derive their value from an underlying asset. And options are the right to buy or sell a certain asset for a certain price at a certain time, and futures are contracts to buy or sell a certain asset for a certain price at a certain time. So they are structured as obligations, not really as rights. And then swaps are more complicated contracts where two parties agree to exchange the cash flows or liabilities of a financial instrument. And a credit default swap is an example of this. It's a kind of bond insurance where you pay a premium, but if the bond collapses, if the bond fails, defaults, you get money in return. And the whole reason you hedge your positions is to protect yourself against market risk, but you cannot completely protect yourself against market risks and still be profitable. So therefore, it's still very important that you're able to identify market risks in time so you can act accordingly. And there are a lot of indicators that you can use to identify market risks with, besides the one that I already discussed when we analyzed the portfolio. And one of them is what you call a yield curve inversion. And this occurs when bonds with shorter maturities have a higher yield than those with longer maturities. And this has been a very reliable predictor of recessions in the past. You can look at VIX, which is a volatility index that essentially measures how much fear or even panic there is in the market. And the higher this is, the greater the fear or the greater the panic. You can look at the unemployment rate, because if the unemployment rate increases, it's not a good sign for the economy. Less people work, less people pay tax, more people collect unemployment benefits, which is, completely out of balance and not the equilibrium you like to have. You can look at the CDS spreads, and what this essentially means is if the CDS spread, so the spread of credit default swaps, if that rises, it means that the cost to insure against a company's default has increased as well, which means that the likelihood of companies defaulting has also increased. You can look at the fear and greed index, which is an index that indicates whether investors are greedy or if they have fear. You can look at the put to call ratio. If there are way more puts than call options, um, yeah, investor sentiment is very bearish. And you could look at interest rate changes. If the interest rate increases, people usually tend to save more, spend less, and they don't really stimulate the economy as much as we would like to see. And also from a mathematical perspective, if the discount rate increases, um, the present value of equities and of bonds decreases as well. And yeah, I think it's time to start wrapping it up. We're almost at the 7-minute mark. So now you should know how to analyze a portfolio. You should know the basics on hedging and how to identify market risks. But next week, I will go into much more detail when it comes to hedging. So thank you for watching, and I'll see you then. Bye.